Welcome to the Buybox Experts podcast. We bring to light the unique opportunities brands face in today's e-commerce world.
Hi, this is James Thompson from the Buybox Experts podcast. Today's episode is part of a special series of interviews that we have done to dive deeper into the recent phenomenon of private equity companies and FBA aggregators investing in private label brands that are leveraging the Amazon sales channel. As part of this series, we interview a wide range of investors, brokers, consultants, and entrepreneurs that have recently sold their private label brands. We peel back the layers on what's happening in this new investment space and look at how private label brands are finding financial success through the building and eventual sale of their online businesses. For 3 weeks, from mid-February through early March, we will release a new episode every weekday on this topic. Sit back and enjoy today's episode. Hi, I'm James Thompson, one of the hosts of the Buybox Experts podcast. I'm a partner with Buybox Experts and the former business head of the Selling on Amazon team at Amazon, as well as the first account manager for the Fulfillment by Amazon program. I'm the co-author of a couple of books on Amazon, including the recent book, Controlling Your Brand in the Age of Amazon. Today's episode is brought to you by Buybox Experts. Buybox Experts takes ambitious brands and makes them unbeatable. When you hire Buybox Experts, you receive the strategy optimization and marketing performance to succeed on Amazon. We also support investors with due diligence services. Go to buyboxexperts.com to learn more. Before I introduce our guest today, I want to send a big shout out to the team at Disruptive Advertising. For off-Amazon advertising, Disruptive Advertising offers the highest level of service in the digital marketing industry, focusing on driving traffic, converting traffic, and enterprise analytics. Disruptive helps their clients increase their bottom line month after month. Check out disruptiveadvertising.com to learn more. Our guest today is Sebastian Rymarz, CEO and co-founder of Heyday. Heyday partners with sellers to acquire, launch, and incubate successful brands on digital marketplaces like Amazon. The platform is being built using technology, data, and operations tailored specifically to marketplace commerce. Prior to Heyday, Sebastian worked for Fundbox, a firm specializing in providing revolving lines of credit to entrepreneurs. In full transparency to our listeners, I am an advisor to Sebastian and Heyday. Sebastian, welcome, and thank you for joining me today on the Buybox Experts podcast.
James, thanks for having me, and thanks for having us.
So let's talk about all these FBA private label businesses. They're a hot commodity today, and yet what's happened recently to create so much interest in these firms? These firms have been around for 20 years since the beginning of the Amazon marketplace, but investors have really only started paying attention recently. What are your thoughts on that?
Yeah, it's interesting. I think, like most interesting questions, it's a complex system. There's not a simple answer. Cause and effect is a little complicated, but a few factors. One is the scale of the opportunity, right? So this went from, you said 20 years ago, it's a small marketplace, to it's a large marketplace, to, oh my gosh, there's 300 billion of GMV.
Right.
All of that accelerated by COVID. You know, what did the McKinsey report, 10 years of COVID, 10 years of e-commerce penetration in 3 months' time. So I just think it's a completely different scale of opportunity than it even was a few years ago. Okay, and that's going to attract investor interest. 300 billion of GMV, that's massive.
That's a big number. Yep.
It's a big number. I think the other is the secular trend. So not only is it big, but it's growing at faster than the rate of e-commerce growth, right? Which that's an important thing, right? Digital marketplaces are gaining share of e-commerce. I think in 2019, Amazon grew at like double the rate of e-commerce growth, right? Also big, by the way, that trend just makes a ton of sense. Like, why would I want to click on 8 different Instagram ads and go to 8 different websites? Why wouldn't I rather have one-stop shopping? Okay. And the data edge that a platform like Amazon has and its ability to use that to personalize the experience. And, you know, e-commerce is still a physical business, and economies of scale matter, and the ability to deliver in 1 or 2 days matter. So all of that really points to this trend continuing. And I think people are seeing that. And by the way, by that trend, I'm specifically talking about digital marketplaces. I think another thing you can point to is this sort of like realization of the value of an Amazon account. Okay. Look, it's easy to take things for granted. I think most things at one point in time were an innovation or a realization. And I think realizing, okay, wait a second, there's all this traffic coming to Amazon and it's searching for keywords, and that's pretty predictable.
Yep.
And then there's all this organic shelf placement. You could think of it as digital shelf placement, right? And that leads to traffic. And so then you start looking at things like, well, what accounts for your digital shelf placement? And it's all of these intangible assets that have to do with the account, right? From reviews to its history, et cetera. And I think you start to look at it that way and you realize, oh, this is different than buying just any other e-commerce business. There's ways to underwrite defensibility in that digital shelf placement or in that revenue stream. And I think that reminds me a lot of, I before becoming an operator and spending 6 years helping build Fundbox, I was an investor and I spent a lot of time doing what's called special situations investing. I spent a lot of time in credit and new emerging ecosystems. And one of the things, if you look back to software, it wasn't a no-brainer that a bank would lend to a software business. Banks would lend to businesses that have hard assets, and banks would lend to business.
What are the assets when you're an Amazon seller? It's a lot harder to see it and feel it in your hands.
Well, right. And where I was going with the software analogy is then there was this realization, well, wait a second, that contract itself is an asset and there's a recurring cash flow stream there and you could underwrite to it. And so in a similar way, I think there's been this realization about the value of this Amazon asset. And that's a special thing. Look, I think another thing I would point to is there was a successful proof point in the market, and that's Thrasio. Okay. I think people talk about, I don't know if you've heard this expression, the 4-minute barrier or 4-minute mile barrier. And that goes back to this idea that humans have been trying to basically run a 4-minute mile for ages. And then finally, this guy, Roger Bannister, sometime in the 1950s or 60s does it. And then that same year, a ton of other people do it because he proved it was possible. And I think, look, props to Thrasio. They went out there and they weren't the first, right? There were others ahead of them, but they were first to do it successfully. And it's very impressive what they achieved. And I think that opened a lot of eyes and that made it possible. And I think for investors especially, that's a validating data point. And you can point to other things. You can talk about, well, listen, there's now there's an M&A ecosystem of brokers, and that's grown a lot. And transferring Amazon accounts from one person to another is easier. So there's all these other factors. I'm not going to point to one or two. I think it's a combination of all of them. And of course, all of it kind of accelerated by COVID.
You didn't come up through the Amazon system as an FBA seller. You were an investor and then came to the Amazon space. Let me ask you, when you look at what's going on in the private label space for these Amazon sellers, what are some of the surprises or what are some of the issues that surprise you the most about what's going on in this subculture of entrepreneur?
Yeah, well, listen, let me just start and just touch on your first point. You're right. I didn't come at it as an Amazon seller. I didn't grow up in e-commerce. I spent the last 6 years helping build a business, Fundbox, which revolutionized access to credit for entrepreneurs, many of whom are Amazon sellers and also other small businesses, right? And we built a solution that allowed entrepreneurs to access credit literally in 30 seconds, okay? And we did that by tapping into this tectonic shift in the data landscape that was happening. By the way, I have a point in saying all of this, so you should just bear with me for a moment.
Of course.
At the highest level, what we were doing at Fundbox was deploying capital, data, and technology to help transform an entrepreneurial ecosystem. And that's how I view what we're doing at Heyday, is we're taking capital, data, and technology, and using it to transform an entrepreneurial ecosystem. In this case, it's the digital marketplace economy, okay? And frankly, what drew me to the space, James, and is, I don't know if I ever told you this story, frankly, but we were actually pitching Amazon execs in late 2019 on embedding our credit solution at Fundbox into their marketplace. And just a couple realizations hit me in that conversation that really set me on this course. And one of them was, yes, Amazon's an impressive company. Yes, this is an amazing and huge marketplace that's growing quickly. But what we're really looking at here is the world's largest retail economy. That was one realization. And then the other realization was, if you looked at the sellers on this ecosystem, okay, and if you just kind of rank them by estimated revenue, they exhibit a power law distribution, right? Like most marketplaces, something like, and I'm going to be a little bit loose with the numbers, but something like 90% of Amazon sellers do less than 100,000 of revenue, something like 98.5 do less than $1 million, somewhere around there, right? But here's what's interesting. If you look at that top 1.5%, no one's doing 20 billion of revenue or 10 or 5 or even 1. And maybe this year there'll be a couple that cross the 1 billion threshold. But that to me was surprising, because although Amazon has lowered the barriers to entry for competition and made it much easier, right? Today, you and I can go on Alibaba, we can source a product, we can slap a label on it. It doesn't take a lot of money, and we can start selling. Doesn't mean we're going to be successful, but we can start selling. But there's still an advantage to scale, right? If we, for example, have sourcing agents on the ground, if we have an industrial design team, if we have quality assurance, if we have scale with our freight forwarders, all of those things are going to lead to better outcomes. So the realization was, whoa, this is an economy that is massive, growing quickly, and in the early days of institutionalization. So anyways, that's a little bit of the backstory I wanted to touch on, because you may, in the audience, may be wondering how I found my way to this space. I think as far as the question around kind of what surprised me, look, I'd say I wasn't so much surprised as I was impressed. You know, I spent the last 6 years working with entrepreneurs. I loved it, and I still love it. That's why I was excited to get back into it. They're scrappy, they're hardworking, they're imaginative, and frankly, they have a lower ego than most folks I know. So it's just been more of that, and very exciting.
To make this marketplace work, there has to be a lot of manufacturing capacity available for small entrepreneurs. And when you look at all these private label brands, many of them started off by getting on a plane, going to China, going to some big fair, finding a manufacturer, and as you say, creating a situation where they're white labeling something as their own, and that's fine. But that nonetheless needs entrepreneurs who are willing to take risks and willing to try new things out. How does an investment group like yours leverage that enthusiasm and be able to take it to the next level?
Yeah, well, okay. First of all, and I'll say this politely and respectfully, of course, but we're not an investment group. And I think it's a really important point to make, because there's really nothing about what we're doing that's an investment group. I don't think you would call Procter & Gamble an investment group, or Unilever, or Shopify, or Amazon. We have nearly 50 people today, and I'd say maybe 4 or 5 have investment background, but plenty have supply chain, operations, e-commerce background. So I just start with that.
Fair point. Yep, fair point.
And I think as far as, what was the question around leveraging? How do we leverage the enthusiasm?
Because quite frankly, these small entrepreneurs are seeing opportunity. They're taking risks. They're finding opportunity to build product that is meeting some new need that may not otherwise be there. As you take brands to the next level, how do you also capture all of that enthusiasm and all of that manufacturing capacity and willingness for people to take risks? What does that mean for a company like yours?
Yeah, well, listen, so I think first of all, one of the things we always talk about and are just very fearful and mindful of is like, we cannot lose that entrepreneurial energy and passion once we acquire a brand, okay? Like, those entrepreneurs, the reason they found success and the reason they're selling is because of that energy. And that's a very difficult thing to bottle up. But it's very easy to go acquire a business and like break everything into an assembly line. And like, by the way, we do that, right? We have an operations platform. We have a technology platform. We have a growth platform. But at the center of our model is a brand management team. And we really try to, frankly, we want entrepreneurs to stay on and build their businesses within Heyday in many cases. And we do have examples of that. But for us, how do we do it? Well, we just put a lot of focus against it. And then I think what our opportunity is to take what the entrepreneurs created, okay, and then help accelerate it, okay, and help grow it.
So Sebastian, you talk about all these amazing entrepreneurs. Talk to me a little about where you're finding these people. How are you finding them? I look at all the aggregators out there right now. A few months ago, everybody was going to the brokers. And quite frankly, that's a lot of people looking at the same deals. How do you think about the process of finding entrepreneurs who are looking to sell their business? How do you look at the process of finding the right kind of companies that make sense for your firm?
Yeah. So look, when we started, we worked almost exclusively with brokers. Okay. It's just a very easy way to get started. And by the way, we still work very closely with brokers, frankly, even more closely than we did before. And they're great partners. But the thing that's been so amazing is over the last several months, honestly, something like 80%, 90% of our deal flow has been organic inbound to our website, just from folks hearing about Heyday, referrals. It is truly insane. There's too much for us to process. Like, we're actually passing off opportunities to brokers because we just can't get through them all. We can't execute that fast. And
that's amazing.
It's a great problem to have. And I think it's because the word's getting out there about us. Great brands know that Heyday is a serious buyer, well capitalized, very seller friendly. And frankly, great brands know that Heyday, if we love the brand, is going to pay more than anyone else because our platform and the investments we're making afford us the ability to do that. But there's another thing that, we've been slowly talking about with our entrepreneur partners in the entrepreneurial community. We haven't really gone public with it to date. So I guess this is going public with it, James, here. And that's that we let our entrepreneur partners invest or take Heyday equity as part of the purchase consideration.
Okay.
All right. And that's a really important point because there's a lot of talk in the space about multiples going up and, when we can speculate, it'd be fun to speculate kind of where this ecosystem's going, but whether multiples are 3 times SDE or EBITDA or 4 or 5 or even 8, they're not going to be 25 or 35 or 40, which is where platforms trade. And to us, that's sort of like not fair. Why do the entrepreneurs leave so much value on the table? And so we give them an opportunity to participate in it by taking Heyday equity. And frankly, we want our entrepreneur partners to be our largest investor. So, we talk about our mission being to help e-commerce entrepreneurs reach new heights, and we mean it.
This brings a whole different meaning to the second bite of the apple, where you may sell your business and you may have an earn out over a short period of time. But if you're now owning a piece of the marketplace and you're able to participate in what hopefully one day will be a big payday for everybody when you go public, that's very exciting for everyone.
We agree.
Very cool. Very cool. Well, let me ask you this. When you look at private label firms today and they jump into this market, how do you see private label brands getting their head around the idea that at some point they could build up to be big enough that they could actually sell? I've worked for so many private label sellers who get into this because they can create a job for themselves. And yet over the last couple of years, they're starting to realize, wait a minute, I can actually sell and make a lot of money. It's the strange disconnect between why they got into the business and why they may now be getting out of the business.
Well, I don't know that all of them think that they're getting out of the business, because I think many of the entrepreneurs we speak with, for them, it's just a way to de-risk, right? Like, think of it this way. Okay. You've built something. Now that something, and by the way, before there was a market for acquisition, that business was effectively worth the cash flow that it was generating. There was no way to capitalize that cash flow, right? And there was no necessarily enterprise value creation. Now there's a market. Now there's enterprise value. So here I am, an entrepreneur building a business, enjoying it, growing it. And then I'm like, wait a second, I'm sitting on something worth $10 million. And $10 million is maybe a lot of money to me. In fact, when measured against all of my assets, $10 million, maybe 98% of my net worth. Well, I don't think anyone would go put 98% of their net worth in any one stock, right? Or in any one asset. And so there's sort of like a desire to de-risk, and it's a rational desire to de-risk, right? But then a lot of the same entrepreneurs, when we ask them, what are you going to go do? They say, I'm going to go do it again because this is what I love. So I don't necessarily think that those are in conflict with one another. At least from our experience, what we've seen is a lot of entrepreneurs de-risking and then going and doing it again. And frankly, we'd encourage that, right? Like that's a prudent thing to do.
So let me ask you this. You see so many deals today across your plate. How do you evaluate a company and see not only is it a good business today, but it has a lot of future runway using the kinds of assets that you can bring to the table?
Yeah, look, I mean, I may be a little cagey about what I share here. I don't want to give away the secret sauce. Sure. I'll say a couple of things. First of all, at Fundbox, I had a driver's seat view to the power of data science. Okay. And we're bringing that to play here at Heyday when it comes to evaluating firms. Okay. And one of the big benefits of the Amazon ecosystem is the power of data on the competitive universe and customer feedback. There's just so much you can learn. You just have to make the investments, right? You have to put the resources into learning it. Okay. So we've done that, and we mine and draw insights from a massive data set. And it's actually a fairly sophisticated process. That said, it boils down to two simple things. Okay. We evaluate defensibility and we evaluate opportunity. Okay. And when we talk about defensibility, we're talking about things like, what's the quality of the product? Okay. I don't care if a product has 100,000 reviews and, the most amazing margins and trends. If they have a low quality product, which by the way, like that typically won't happen. Those are in conflict with one another. But if it's a low quality product, like it's just hard to get excited about that, especially if you don't have a game plan on improving that. So at the end of the day, like, product quality matters. That's our view. And even if it doesn't matter in the short term, it's going to matter in the long term. Okay. Product differentiation matters. I can't tell you how many businesses that we've looked at where it is, let's call it reseller 2.0. It is a product that is identical to 30 other products on the marketplace, rolling off the same assembly line with just a different label on it. Okay. And frankly, it may have a more interesting account attributes, right? More reviews, better reviews, et cetera. But at the end of the day, that's hard to get excited about, right? Because there's not much product differentiation. Again, I think in the short term, you can get excited about, but in the long term, it's not there. Vulnerability of listings position is something we evaluate. I think when it comes to, that's all things that kind of factor into defensibility. And I think the other thing to focus on here is opportunity. What can our platform at Heyday do for brands? Our operational platform, our tech platform, our growth platform, what can we do to improve? Okay. And we're building a platform such that brands are worth more inside of Heyday than outside. And that's what I'll say on that.
So while you mentioned some of the aspects of your business around how you do things, talk to me a little bit about how you make things interesting for buyers to get them excited about selling specifically to Heyday.
Yeah. I think what all buyers will tell you is that the most exciting thing is a big price. And it kind of starts there. And I think we are competitive. And when it comes to brands we like, and I think we are more selective than others, when it comes to brands we like, we pay more. And again, we can afford to pay more, as I mentioned before, because of those platform investments that we make. Now, as far as our process and how we differentiate, look, people talk about speed and I close in 30 days, I close in 25 days. Like, we're fast. Okay. We're as fast as is the fast. We can close in 2 weeks. We'll close in 3 weeks, but like, I don't think a day here, a day there is going to be the differentiator. I think second to value, is trust. Okay. Because at the end of the day, there's a lot of diligence, there's a lot of contracts, but at the heart of it all lies trust. Okay. And a seller has to trust you. And I think we've been very trustworthy, and we've done a great job as we've engaged with sellers to, earn their trust, build their trust, and then ultimately keep their trust. Okay. And so that's a very important point, because things come up, right? Things come up after the APA is negotiated and signed. Things come up during diligence. And again, if you have a trusting relationship to kind of fall back on, that's what's critical. And that's how we like to differentiate. We're also very seller friendly. Our lawyers have told us we have the most seller friendly APA. Doesn't mean we do, but that's what we've heard, and that's what we strive for. And we're not going to nickel and dime that. Just like we don't think that's the right approach to the market. And so, I'd say that's how we differentiate.
So what do you think will make your business successful in the long run? How do you see FBA investors getting their value out of the growth effort that they're putting into their portfolio brands?
Yeah. Look,
we're kind of at that stage right now where there are a lot of new companies who've come into the space that are buying up brands, and it's exciting times. But in the next 2 years, a lot of things will probably change as it becomes more apparent that there are companies that know what they're doing and there are companies that don't know as much of what they're doing. Take me through your thoughts.
Yeah. Okay. So a lot to unpack there. Let me start with, you hit on some interesting points about how this all will evolve, and it's fun to play Nostradamus. So let me, dangerous but fun. So let me try to play. I think, you mentioned there will be some failures. I could not agree more. I think there will be a lot of failures. I think there are a lot of teams that underestimate the operational complexity. And I think they view this as an investment operation. And it is anything but. Okay. Wait till they start drowning in purchase orders. So I think that there will be failures. There have been failures in the past. And I think a big thing there is underestimating operational complexity. By the way, the flip side of that is I've also seen e-commerce and operational teams that have no investment experience. And so how can you possibly acquire a business and think about risk reward if you have no one on your team that has experience in that? And I think people will make mistakes. And if you buy wrong, no matter how well you invest in the operations, it's going to be tough. Okay. So I think there'll be a ton of failures. I think there's going to be a lot of winners. Look at the CPG ecosystem. It's not like there's only 5 companies. That said, James, I think that it's not going to be winner take all, but I do think it's going to be leader take most capital, which you also see in the traditional CPG world. Like, look, Procter and Gamble I'll be plus or minus 10, 20% off here, but I think Procter and Gamble is like a $300 billion company. And then go look at Unilever. They're like roughly half that value. And then go look at a business like Colgate-Palmolive. They're like roughly half the value of Unilever. But there are a ton of CPGs, but there are a few that have commanded most of the value and most of the capital. And I think that that's what's going to happen here. I think that it's not winner take all. There'll be a lot of winners, but it will be leaders take most capital. I think there's going to be specialization by vertical, by type of business. I think that has to happen. I think, there are folks that say like, oh, how can you possibly make this work without specialization? And I don't like buy that. There's a lot of economies of scale and leverage. And, for example, like what does owning Tide detergent have to do with owning razor blades? Like those are 2 very different verticals and they exist within a company. Yep. So I don't think that that's required, but I think it will happen. And I think there's advantages to it happening, specialization by geography, by vertical, et cetera. I think platforms, and by the way, I think those leaders, so, I mentioned leaders will take most capital, and this will get to your first question around, how basically we're going to succeed in the long run. Right. And how other firms will succeed in the long run, which is, I think the leaders are going to be the ones that invest in a platform. So look, I think there's a great analogy to be drawn here with the traditional CPG ecosystem, the Procter and Gambles of the world. The reason a brand is worth more inside of Procter and Gamble than outside of Procter and Gamble, the primary reason, there's a lot of reasons why, but the primary reason is because their distribution, the relationships they have, the shelf placement they've guaranteed, that is a difficult asset to replicate. Okay. And here's the thing though, that's traditional physical retail. Now you move into the digital marketplace economy. Okay. And the internet has basically changed the calculus of distribution. It's less important, right? And so now you have digital marketplaces. The companies that win there are going to be the ones that invest in technology. Okay. They're going to be the ones that invest in brand, in creative, and operations. Okay. And so it's almost like the architecture, the platform you need to win on a digital marketplace like Amazon is different than the one that you need to win in a physical retail environment. Okay. And by the way, that's not to say you can't sell into physical retail and also in a digital marketplace. That's not what I'm saying. But there's no way you can win on both. You can't be the best at both. Okay. Right. Because ultimately your organization is tooled for one of those ecosystems. Okay. So I think the businesses that win are going to be the ones that invest in the platform. Okay. And that's what we're doing. Okay. One of our first hires was a CTO, very experienced one. We've been building our tech team. It's really big already and a big portion of our company. We're making those investments in the platform. Our operations team is huge. We're making those investments in the platform. And I think that's how you build an enduring business here. Okay. Because then here's what happens. Multiples start creeping up and eventually they're going to be a lot higher. And it's going to be hard to make money with the high multiple unless you have a platform. And one of the interesting things about this ecosystem is because multiples are low, even today, I think they're very low relative to the value there. And because capital is cheap, relatively speaking, we're living in a very capital rich world. There's been a lot of stimulus. Those two forces together are creating a massive subsidization of that platform. Now, some people will take that, like what we're doing, and invest in the platform. And eventually, when those dynamics go away, when it's a lot more competitive, the folks with the platforms are going to win. Now, there is another way to play this. And I think a lot of people are playing this as a trade. They see it as a financial arbitrage opportunity. Okay, which, by the way, it is. Because when you buy businesses for 3, 4, 5 times, and then you can trade for 20, 30 times, like that's like the world's biggest valuation arbitrage, right?
Yes.
Now, I think the issue with thinking about it as a trade and thinking about it short term is that invariably you're going to underestimate the operational complexity. You're not going to make the necessary investments, and either you're going to get tripped up by it, or just as bad, once the world turns to very competitive, a year from now, 2 years from now, 3 years from now, you're not going to have an edge and you're not going to be able to compete. All right. So I think the winners are going to be the ones that invest in the platform and take advantage of those dynamics.
Sebastian, I want to thank you for joining us today on the Buybox Experts podcast. For those of you interested in learning more about Heyday, please visit heyday.co. Join us next time on the Buybox Experts podcast.
Thanks for listening to the Buybox Experts podcast. Be sure to click subscribe, check us out on the web, and we'll see you next time.